Welcome back to the deep dive. Today, we're plunging into the world of Align Technology, Inc. You probably know the ticker ALGN. Our analysis date is June 21, 2025, and the share price back then was sitting at $181.79. Now, Align Technology, they've helped create, over 19 million perfect smiles, pretty much dominating their market. But here's the really fascinating question we're tackling. With patents expiring, new competitors popping up, and, some serious economic headwinds hitting consumer spending, is Align's best growth still ahead? Or is that perfect smile maybe starting to show a few cracks? The stock's valuation right now, it's kind of sitting at the lower end of its estimated value range. That poses a really critical question for anyone looking at this company. Before we jump in, just a quick note, this deep dive, like all our analyses, is powered by our partnership with Stock Analytics AI. Remember, members get priority deep dives, and over the next few months, we're covering all the S&P 500 stocks just for members. So if you want deeper dives on specific companies, you know where to find us.
Exactly. And our mission today is really to unpack Align Technology. Look at all the complex layers of business model, the financials, the forces shaping its future. We want to help you understand not just what the data says, but maybe more importantly, what it actually means for Align's path forward and for you.
All right, so to really get a grip on Align's power, we have to start right at the core. How do they actually make money? Let's kick things off with Chapter 1, The Business of a Perfect Smile, a fundamental analysis.
Yeah, and what's really interesting here is that Align operates on this powerful, almost synergistic two-segment model. It creates this self-reinforcing kind of loop. So the main profit engine, where most of the money comes from, that's the clear aligner segment. This is where they sell Invisalign, their famous clear aligners, directly to dentists and orthodontists. It's a B2B2C model.
Oh, yeah.
And that brought in, let's see, about $3.2 billion of their total $4 billion revenue in 2024. Okay, then there's the second segment. Systems and services. This is like the strategic linchpin. It includes their iTero intraoral scanners and the Exocad CAD/CAM software they acquired. Now, revenue here was smaller, $768.9 million in 2024. But the key thing is, these scanners and software, they're not just hardware. They act as this crucial funnel. They pull dental practices into Align's digital world. And that makes it way easier and more efficient for those practices to prescribe the high-margin Invisalign aligners.
Ah, okay. So that classic flywheel effect we hear about. Get them hooked with the scanners, and then the practices are basically locked into the whole Invisalign system.
Precisely, yeah. If a practice invests in an iTero scanner, they're naturally incentivized to use it, right? Especially for high-value stuff. And the scanner works seamlessly with Align's ClinCheck software. It streamlines everything scan, design, aligner production. So this integrated workflow, it saves doctors time, cuts down on errors, makes the patient experience better, and it helps boost case acceptance rates with tools like the outcome simulator, showing patients their potential new smile.
Right, visualization cells.
Exactly. So the more a practice uses the system, the more embedded it gets. That creates real switching costs, real loyalty, and that drives those recurring high-margin aligner sales, which, in turn, funds more R&D, making the whole ecosystem stronger. It feeds itself.
That deep integration, yeah, that sounds like a powerful advantage. Just how dominant is Align in this market? Are we talking like a giant among minnows?
Oh, Align Technology is, without a doubt, the undisputed leader in clear aligners, hands down. They hold a commanding market share. Estimates vary a bit, but somewhere between 80% and maybe even 90.5% in the doctor-directed category.
80 to 90%, that's huge.
It really is. And it's not just, in the U.S., it's global. Operations in over 100 countries. A network of more than 230,000 trained doctors. And think about this. By the end of 2024, over 19.5 million patients had been treated with Invisalign. What that means is Align has this incredible, unparalleled treasure trove of clinical data, which they constantly feed into their AI for innovation. It makes their system self-improving. It's a cycle that's really, really hard for competitors to replicate.
That massive patient database and the doctor network, that's got to be a serious moat. But okay, what does it all mean for the actual patients and doctors, beyond the business mechanics? What's the real value they're getting?
Well, it's kind of dual-layered, right? Catering to both sides. For patients, the appeal is obvious. Invisalign offers this aesthetic, comfortable, convenient alternative to metal braces. They're nearly invisible. You can take them out to eat or brush. Simpler.
Yeah, much less intrusive.
Right. And then for doctors, the value is all about clinical effectiveness and practice efficiency. The Align digital platform gives them a predictable, efficient workflow. It can handle, something like 90% of malocclusion cases. It boosts their productivity. Plus, it gives them powerful digital marketing tools like that outcome simulator we mentioned, showing patients the after picture really helps close cases.
Makes sense. Okay, so shifting gears slightly, what about the bigger picture, the industry itself? Is this market growing, and who are the main challengers Align needs to worry about?
Oh, the industry is seeing explosive growth. It's driven by some really strong long-term trends. The global clear aligner market, valued somewhere between, say, $5.1 billion and $6.8 billion in 2024. It's projected to surge. We're talking over $24 billion by 2030. Yeah, that's like an 18 to 23% compound annual growth rate. Huge. And what's fueling it? Well, more focus on aesthetics, more adults wanting treatment. The teen segment is actually the fastest growing. Plus, tech advancements, 3D printing, AI, even things like dental tourism play a role.
Yeah.
Now, the competition, it's evolved. Direct competitors, you've got Dentsply Sirona, Straumann Group, and Vista Holdings that make Stark and 3M. But here's a key insight. The threat from those direct-to-consumer, or DTC, players, like Smile Direct Club, that seems to be fading.
Right, they went bankrupt, didn't they?
They did. And their failure, in a way, kind of validated the importance of having a doctor involved. It shifted focus back to doctor-led care. So with some of Align's early patents expiring, the real fight now isn't just about who can print plastic trays, it's about who has the best, most comprehensive digital platform. Align's durable advantage really is that integrated platform and those deep, loyal relationships with doctors. It's not just a product, it's an entrenched workflow.
That's a really thorough look at the business side. Okay, now let's talk about the people in charge, the ones steering the ship. We're moving on to Chapter 2, Evaluating the Architects, Management and Capital Allocation.
Yeah, because the company's long-term success often really reflects its leadership, right?
Yeah.
Align is led by a pretty seasoned team. Joseph Hogan, he's been CEO since 2015. His background is impressive. Former CEO of ABB and notably CEO of GE Healthcare. While at GE Healthcare, he apparently doubled revenues to $16 billion.
Okay, that's serious experience.
Definitely. And the CFO, John Morici, since 2016, also comes with over 2 decades of leadership, including time at GE Healthcare, too. So the key insight here, I think, is that their experience scaling these massive global companies like GE and ABB is kind of perfectly suited for guiding Align. They need to shift from being mostly U.S.-focused to a truly global medical device powerhouse. And these guys have run that playbook before.
The resumes certainly sound right for the job, so how are they actually using the company's money? What's their capital allocation strategy telling us about their confidence level?
Well, their strategy seems squarely focused on 2 things: reinvesting for long-term growth and returning capital to shareholders. They put a significant chunk of revenue into R&D, $316.1 million, or 8.7% of revenue, in 2023. That's vital for staying ahead technologically, with AI, materials, the digital platform. They also do strategic M&A, like buying XCAD to enhance the ecosystem. And they make equity investments to expand distribution, like that $75 million they put into Heartland Dental.
Okay, R&D, M&A. What about shareholder returns?
Right. So Align doesn't pay a dividend. They prioritize reinvestment and pretty aggressive share buybacks. They just finished a $1 billion buyback program on May 1st, 2025. And then, boom, May 6th, they authorized a new $1 billion program.
Cover billion right away.
Exactly. And what's compelling about that, especially with the stock well off its all-time highs, is that it's a powerful signal of management's confidence. There's a super strong balance sheet, hardly any debt. So choosing buybacks repeatedly over, say, a dividend or some huge acquisition, it strongly suggests they think their own stock is undervalued. A good investment.
Yeah, that's putting your money where your mouth is. Okay, from the architects to the blueprints, the financials. This brings us to Chapter 3, the financial X-ray. A health and valuation check.
Okay, financials. Align's market cap is around $13.18 billion,
Yeah.
so firmly large cap medical device territory. Revenue trends. It's been a story of strong growth, but definitely cyclical. Trailing 12-month, or TTM, revenue was $3.98 billion in Q1 2025. Now remember 2022? Massive growth, like 43.2%, probably some post-pandemic revenge spending on aesthetics.
Right, pent-up demand.
Exactly. But then, as inflation and economic uncertainty bit down, revenue actually shrank by 8.1% in 2023. It seems to have stabilized more recently, with modest 1.64% growth in Q1 2025. So the key takeaway here is, yeah, the long-term growth story seems intact, but because aesthetic orthodontics is discretionary spending, performance is pretty sensitive to how confident consumers are feeling.
And what about profits? You hear about their margins being really good.
Oh, they are. Align consistently shows these really impressive, almost software-like profit margins, their TTM gross margin, around 70.0%.
70% gross margin. Wow.
Yeah. Their TTM GAAP operating margin is roughly 16.5%, and TTM net profit margin is about 10.3%. Those are really strong numbers for a medical device company.
Those margins are impressive, but does that make them vulnerable? I mean, could margins that high attract even more aggressive competition or maybe even regulatory attention down the road?
That's a fair point. And yeah, high margins definitely attract rivals, no doubt about it. But Align's advantage, going back to that moat, lies in its sticky, integrated digital ecosystem and the sheer scale they've built over decades. That creates pretty high barriers to entry. It makes it tough for competitors to just come in and replicate their profitability easily.
Yeah.
And in terms of financial stability, Align is a robust, free cash flow generator. TTM FCF was $630.74 million. Healthy.
This cash flow is what funds their R&D, those strategic investments and the buybacks we talked about,
Right.
and their balance sheet. It's like a fortress. Exceptionally low debt-to-equity ratio, 0.03. Better than like 87% of their peers.
So tons of flexibility. Maximum financial flexibility. And their current ratio, short-term liquidity measure,
Yeah.
1.21 in Q1 2025. Also healthy.
Okay, let's talk valuation. For listeners who might know the basics but need a quick refresher, how can we simply think about intrinsic valuation, like a DCF model? What does it really tell us, and why is it important here?
Okay, yeah, good question. Think of a discounted cash flow, or a DCF model,
Yeah.
like valuing a fruit tree. You're not just looking at the apples on the tree today, you're trying to estimate all the apples it's going to produce over its entire life, all its future cash flows. And then you discount that total future value back to what it's worth in today's money. For a company like Align with all this long-term growth potential, looking at those future apples is critical to understanding its real value beyond just this year's earnings. Makes sense.
Yeah, future potential discounted back. Got it.
Right. Now, a DCF isn't, a magic crystal ball. Its output is super sensitive to the assumptions you plug in. Things like future growth rates, the discount rate, which is the weighted average cost of capital, or WACC, around 6.9% for Align. If you look at publicly available DCF models for Align, you see a pretty wide range of values. A more conservative model might put the value around $169.39 per share, but a more optimistic one could estimate it as high as $318 per share.
$169 to $318. That's a huge spread.
It is. And that wide range really underscores how different assumptions about the future profoundly impact what people think the company is worth today. Lots of uncertainty baked in.
Okay, with that financial x-ray done, let's switch gears and look at how the market is viewing Align right now. That brings us to Chapter 4, Market Sentiment.
Right, market sentiment. Wall Street, generally speaking, seems positive on Align. But, like that DCF range, there are definitely variations in just how positive. The consensus rating is often a moderate buy or maybe strong buy. Looking at analyst numbers, you see something like 11 buys, 6 holds, and only 1 sell rating. The average 12-month price target clusters around, say, $230 to $241. But, and this is important, that average hides a really wide dispersion. Some targets are as low as $170, others go all the way up to $450.
$170 to $450, so huge disagreement among analysts, too.
Exactly. And the key insight from that wide range, I think, is this ongoing debate. Near-term macroeconomic pain versus Align's undeniable long-term growth potential. Which one wins out? Recent news is mixed, too. You see positive stories about innovation approvals in China, AI software, marketing pushes, that new buyback, but also cautious notes about the stock underperforming, revenue volatility, those macro challenges. Interestingly, though, social media sentiment seems pretty positive overall.
Okay, beyond the analysts, what about market indicators, like short interest or moving averages? What do they tell us?
Good question. Short interest? It's notable, but maybe not extreme. Around 4.5% of the float. That's moderate. So just some bearish bets out there, but it's not like the market is overwhelmingly shorting it. As for moving averages, the stock price, $181.79, was trading slightly above its 50-day moving average. That's usually seen as a short-term bullish sign. However, it's significantly below its 200-day moving average, which was hovering around 203, 205 mark.
Oh, so short-term strength, but still in a longer-term downtrend.
That's what it suggests, yeah. A battle between short-term momentum and the longer-term picture.
Got it. So who actually owns this company? Who's holding the shares? And what does that ownership structure tell us? Let's dive into Chapter 5. Who owns the Smile? An ownership deep dive.
Okay, ownership. Align stock is overwhelmingly owned by big institutional investors. We're talking 88% to maybe even 94% of the shares. Vanguard is the biggest holder, then BlackRock, State Street, Wellington, T. Rowe Price. These are all big names. Now, having this much smart money invested is generally seen as a strong vote of confidence, right? These firms do their homework.
Usually.
But the key insight, or maybe the flip side, is that high concentration means decisions by just a few large fund managers can really move the stock price. If one or two decide to sell big, that creates pressure. And we see some dynamics there. Recent filings show BlackRock actually decreased its position, while another firm, 91 UK, substantially increased theirs. So differing views even among the giants.
Interesting. What about insiders, management directors? Do they have skin in the game?
They do. Insiders hold a meaningful stake, somewhere between 6.6% and maybe 15%. Director Joseph Lacob, for instance, owns over 5% himself. That alignment of interests with shareholders is generally a good thing. Now, there has been net selling by insiders over the past year or so, but looking closer, it seems mostly related to executives selling shares they received as compensation, like exercising options.
So not necessarily a bearish signal, just part of their pay package.
Potentially, yeah. It's common. However, what is notable is the lack of significant open market purchases by insiders. You'd ideally like to see them buying shares with their own cash if they felt the stock was really cheap.
Good point.
Yeah.
Okay, every investment carries risk. Let's put Align under the microscope and look at its potential pressure points we're looking at. Chapter 6, Identifying the Pressure Points, a comprehensive risk assessment.
Right, let's break it down with a quick SWOT analysis. Strengths, weaknesses, opportunities, threats. Strengths, we've hit these. Market dominance, that Invisalign brand power, the integrated digital ecosystem creating a moat, proprietary data from millions of patients, over 1,300 patents, strong financials, solid foundation. Weaknesses, the high price point and the fact that it's discretionary spending that makes it sensitive to the economy. Heavy revenue concentration on Invisalign, and growth still depends on getting more doctors, especially general dentists, to adopt the system.
Okay, makes sense. Opportunities and threats.
Opportunities. Huge untapped market globally, especially in emerging economies. Demographic expansion, teens and tweens are the fastest growing segment, and they have new products like the palatal expander targeting them. And continued tech advances, AI, 3D printing, better materials can improve outcomes and maybe open up even more of the market. Threats. Intense competition from well-funded rivals like Dentsply Sirona, Straumann, always the risk of increased regulatory scrutiny or maybe litigation. Standard stuff for a medical device leader, but real threats.
Beyond those company specifics, what about the broader macro environment and maybe even geopolitics? How are those hitting Align?
Yeah, these are really significant pressure points right now. The current macro picture, high inflation, higher interest rates, it's like a double squeeze.
Yeah.
First, it squeezes the dental practices. Inflation dries up their costs, supplies, salaries. Higher interest rates make financing those expensive scanners tougher.
Right, hits their bottom line.
Exactly. And second, it squeezes the patients. Inflation eats away at purchasing power. Less disposable income means people might delay or just skip elective procedures like Invisalign. This is probably a primary driver of that growth slowdown we saw recently.
Okay, that's the macro squeeze. What about geopolitics? You mentioned tariffs.
Yes, new U.S. trade policies from 2025. There's a new 10% baseline tariff on almost all imported goods. That alone increases input costs. But more specifically, there are steep tariffs on Chinese imports, like 15% on some raw materials, maybe up to 25% on certain medical devices and electronic components. Align source of materials and components globally, so this will directly increase their cost of goods sold. The key insight here is it forces a tough choice. Either absorb those higher costs, which squeezes their impressive margins, or pass the costs on to customers, which could hurt demand, especially in this environment.
Yeah, not an easy position. Okay, we've covered a ton of ground here. Let's try to bring it all together. What's the bottom line for Align Technology? This is our final chapter. Chapter 7, Conclusion.
All right, let's synthesize. The bull case for Align, it's based on that market leadership in a big, growing market, protected by a strong moat brand, doctors, data, financially robust, great margins, strong cash flow, clean balance sheet, experienced management, shareholder-friendly buybacks, and from a valuation standpoint, it looks arguably cheap compared to its own history.
Okay, that's the bull case. What about the flip side?
The bear case really emphasizes those significant near-term headwinds. Growth is sensitive to the macro environment, inflation, interest rates hitting both dentists and patients, competition is heating up. Those new tariffs are a real threat to costs and margins. The stock's been in a long-term downtrend. And while that insider selling might be explainable, the lack of insider buying doesn't exactly scream confidence at current levels.
Right, and the valuation.
As we discussed, that intrinsic valuation review showed that really wide range, didn't it? Roughly $169 on the conservative side, up to maybe $318 on the optimistic side. That just captures the high degree of uncertainty about forecasting their future right now.
So where does the current price fit in?
Well, as of our analysis date, that share price of $181.79, it sits right near the lower end of that estimated intrinsic value range. So if you're a bull, you might see that as a significant margin of safety, a compelling opportunity where long-term potential is maybe being overlooked because of short-term noise. But if you lean towards the bear case, you'd argue the current price appropriately reflects those very real risks, the competition, the macro pressures, the tariffs. Ultimately, I think an investment in Align today, it's really a bet on whether the company's powerful moat and that strong long-term trend towards wanting better smiles can overcome these significant, undeniable headwinds we're seeing right now.
That sums it up well. Thinking about everything we've just covered, Align's clear dominance, but also these very real external pressures. What single piece of information, or maybe what future trend, do you think will be the ultimate decider for Align Technology's path forward? Something for you, our listener, to ponder. And if you found this deep dive valuable, we hope you'll continue your learning journey with us.
Yeah, definitely like and subscribe to the Stock Analytics AI YouTube channel for more deep dives like this one. Remember, members get priority access, and you can even suggest stocks for us to cover in the comments. And we are committed to covering all the S&P 500 stocks exclusively for members over the coming months, so check it out.
And please remember, this analysis was generated by an AI system. It's for educational purposes only and should absolutely not be considered financial advice. Always do your own research or talk to a qualified financial advisor before making any investment decisions. Thanks for diving deep with us today. We'll catch you on the next one.